Jackson Hole and the central bankers powwow in Wyoming last week, and its effects and FX trades that we can use to benefit from what we learned at Jackson Hole. In short, to summarize Jackson Hole, the central bankers were staunch in their determination to keep inflation under control, or try to control it, let's put it that way, by raising interest rates. Interest rates are at a historic low. Even though they're going up, keep in mind the long-term average interest rate in the world is 5.25%. We're not nearly there, and it's going to take us some time to get there. And that is the objective. And it's going to be painful because we've been living in a free money society, depending on how you date it, for between 15 and about 15 years now. So the pain of money costing something is going to hurt the bottom line of corporations. The inflation hurts everybody. Nobody profits from inflation. But let's take a look at some of the currency trades that we're seeing as a result, or the weakness that we're seeing as a result of what's going on, not only as a result of Jackson Hole, but economically generally. I want you to take a look at the dollar-yen rate. This is a tremendous trade. We've been trading this now for weeks, months I should say, and for those of you who are aware of this, and those of you following these signals should be aware of it, Bank of Japan Chairman Kuroda refuses to raise interest rates. He feels that inflation is an imported phenomenon in Japan, resulting from largely the pandemic and the energy crunch that's hitting the world, and therefore he continues to stimulate the economy with incentivized monetary policy, meaning cheap money. And as you look at that chart, pretty easy to make money from that, I would say. So we're looking at dollar yen to continue rising. I also want to point out dollar yuan. The yuan is the offshore Chinese currency. The onshore Chinese currency, of course, is the renminbi. But the yuan, which is a semi-rigged, I should say totally rigged, semi-free currency that's a proxy for the Chinese renminbi, you can see this too. And this has got other reasons. It's dancing above the 20, the 50, and the 200-day moving average and on tremendous volume. And this has its own characteristics to it. Largely, well, there are several factors. One is there's a tremendous property crisis in China. Those of you who watch television know that they have these giant cities that they built that are empty. We're not talking about a few apartment buildings or some commercial space in big cities. We're talking about entire cities, including schools and hospitals and clinics and buildings, and everything empty because they overbuilt. And it's causing a huge overhang financially, debts that aren't being repaid, property aren't being sold, and in the zillions and zillions of dollars. So that's a huge weight on the Chinese economy. Their silly zero tolerance policy for a plague that knows or cares nothing about toleration is proving to be very, very difficult for the economy, closing down entire cities for months on end because of a few isolated cases, mostly because they have a crummy vaccine policy, and the people who are vaccinated are the young people. And they're suffering tremendous droughts and heat problems in China now. So they're really taking a 1-2 punch in China, and the currency is weakening at this rate. So we can leave our summation at that right now. I do want to just point out one more FX trade since we're in FX, and it's one of my favorite trades, and has been now for some time. This is my beloved dollar Turkish lira trade, and this represents entirely 100% the ignorance, the monetary ignorance of the Sultan of Turkey, and as you can see, good. It's a sure bet. So with that, ladies and gentlemen, we'll take leave today. I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.